Right, let's get going. Our guest hasn't quite joined us yet, but I think he's on the way. So we will be talking to Matthias Siller later on. But first, I've got a bit of news to run through. Just a few things that I pulled out really from results and things. Personal assets I wanted to talk about just because they've got some interesting views on the market. Hansa, because something might be going on there with the structure. And Custodian Property Income REIT, which just says something in its results that I thought was worth picking up on. And again, like last week, I probably should have invited Richard to do this, but I've done it myself. Personal assets first. So this has been around for a long time, and it's only really had two managers since 1990. So Ian Brushbrook, I think he unfortunately died. And then Sebastian Line picked up the job in 2000 from March 2009 onwards. And he's now assisted by Charlotte Young. Ever since Ian was running it, the whole ethos of the thing was to protect shareholders' capital. And then once you've done that job, then you can think about increasing it over the long term. And when it says protect, it means in real terms. So for protecting it from inflation. One of the things that they did quite early on for the sector was introduce a zero discount policy. That has worked extremely well for it. And so they do bang on about every other fund should do the same thing. It doesn't work for every fund. It works because the underlying stuff in here is quite liquid. But nevertheless, it's allowed it to expand, and it's expanded by an enormous amount. So actually the fund is almost 10 times the size it was in April 2008. And there's the chart. So nice sort of steady upward climb, more or less, but pretty sort of static the last few years. And I think that's maybe attracting some criticism in some quarters. I think some people are getting thinking it's a bit sort of stale. And that discount looks like it's widened dramatically. That scale here is only +2 to -2. So that really is quite trivial in the scheme of things, but it just does show a shift from trading a premium issuing stock to trading a small discount and buying it back again, probably. This chart here is from their fact sheet, and it's just showing you how the fund's performed since Sebastian took it on relative to inflation. So actually, I mean, over that long piece, it's done a great job. Here it is in the context of the sector. The flexible investment sector is one of these sort of catch-all things at the moment that makes it quite sort of complex, and there are a number of funds doing different things, so that sort of makes it hard to compare. But as I said, it really is now nudging on to over 1.8 billion, a decent size. And because it's decent size, and because they're quite conscious of cost control, the ongoing charges ratio is quite small too, although it's not the lowest in the group. Now, in terms of returns, they are adamant that they want to be judged on long-term numbers. And for that, I think we can probably use 5 years as a reasonable thing. And actually, if you rank these things by 5-year NAV returns, then it does come out quite near the top of the list, just showing you how bad markets have been over that period. It's interesting, I think, that REIT Capital ranks above it in that list. Top of the list, though, is Caledonia, which has had a sort of bit of a purple patch recently and has done extremely well. But because it's all about shareholders' returns, not the NAV return, really, we want to talk about share prices. So if you just rank them by share prices instead, it still comes out fairly near the top. We know that because REIT Capital's discounts widened, it's now back down near the bottom. But actually, it hasn't then been RPI inflation over 5 years, which is disappointing, I suppose. But that, I think, is just a matter of the sort of sharp rise in inflation we've had recently, and I think it will catch up. This is the numbers from the results. Share price down 4.4% over 1 year, but up 22.7 over 5. Importantly, that's its benchmark really with those two. So the UK market plus 2.4 over 5 years, it's way ahead of that. And then RPI, obviously, we talked about already, it hasn't quite matched. So these are some of the things that were in the report that I thought were worth highlighting. So one is that their belief that inflation is going to be quite persistent and fairly volatile, so it will go up as well as down. Which I think may unnerve people if inflation, because it is starting to tick off. If inflation went back up again, particularly in the States, I think that would definitely unnerve markets. They are worried really about valuations for almost all asset classes, but they've been saying that for a long time, and it's this sort of stale bear argument, really. I think that is that people are really sort of wary of at the moment. I do kind of think they're right, though, but I mean, it's very hard to tell. I think the point is you just have to hedge your bets a bit with what you have across the whole of your portfolio. They're adamant that the 2010s was an aberration, and the process of unwinding all of that cheap money and zero interest rate policy is going to take quite a long time to work through into markets. So although we've had some quite savage moves, there could be more to come. And they're also convinced that valuations are too high because people are still fixated on what the earnings multiples were in times when the interest rates were extremely low. And they think that's, they started to factor in that as normal, and he's saying, well, that isn't normal. This is where the portfolio is split today. This is just showing you how it shifted over the course of the past year. And basically what we saw was a big reduction in the equity exposure, and then also a big reduction in the UK Treasury bill exposure. And that is because, for the first time, as he says, there was an opportunity to invest that money in things other than Treasury bills that were going to earn you a decent return. So things like short-dated US Treasuries and gilts have been attractive. The equity exposure they have got now is a 10-year low. What they do own is defensive stocks. I think the question about whether it's sensible or not will comes down to valuation again. They do have an enormous amount of liquidity, but they're not holding it in cash, as I said, because there's more interesting things to do with it. And they do have, I think, about 9% in gold. I think it does say that on that chart. Gold and duration investments is 11. I think that bullion is like just over 9. And they're saying basically that they think that if we head towards a hard landing, which is where they think we're going, then the temptation for our governments is going to be to print money. And that would mean that gold does relatively well. So this chart here, behind the other one, is the gold price in dollars from Bloomberg. That was my attempt to put it into real terms, just deflating it by UK RPI. But of course, then I realized when I just hit go on this that I probably should have turned it into sterling as well to give you a more accurate picture. But nevertheless, what it's saying there is that the gold price has kind of held its own. The big disappointment for them in 2022 was the performance of their index-linked bonds. I'm not sure why they all got caught out by this. It wasn't just them, but it should have been obvious, I thought, that in a world where rates were going to go up, that that would affect the yields in index-linked bonds as well, long-dated ones. But there we go. And as we say, that they are saying that at the moment markets are priced for perfection, and it's not likely to happen. So I just thought that was interesting and worth highlighting to you. Whether you believe it or not, it's totally up to you. It's still a big chunk of my portfolio, this and Trojan, that they also run. Hansa, again, it's been around for a long time, and it's not massively covered itself in glory, and also trades on an enormous discount, as you can see here. And what everybody's very excited about this week is this little spike here, and that was triggered by, and that's something to do with its stake in Ocean Wilson's, which we'll come to. So this is lifted straight from its presentation. It's got a sort of long history, but basically the Salomon family bought into controlling this through Ree Brothers that they used to own. And from a kind of legacy thing, it had this position in Brazil, in a Brazilian ports business, Wilson & Sons, and they're sort of layered. I'll show you here. One of the things that happened relatively recently is it re-domiciled itself to Bermuda, which was blamed on concerns about political climate. I think it was as to protect their voting structure. So that would say it's different layers of things, but basically Hansa Investment Company's got its own portfolio of mainly funds and some direct equity exposure. It also owns this stake in Ocean Wilson's, which in itself is like an investment company. So it's got a whole portfolio of stuff too. There's Ocean Wilson Investments. And then it's got this stake in this Brazilian maritime services business, Wilson & Sons. And that has grown to be a bigger and bigger part of the company. The whole thing is controlled because it's got these non-voting shares and voting shares by William Salomon and his sister. It's one of those things that when I was running Advanced UK, we going back decades now, you know, I was trying to agitate for them to break that up. They're adamant they're not going to do it. And as I said, by making it a Bermudan company, there's no chance really that everyone's ever going to force them to do it. We don't even sort of know now for sure that this chunk of shares is owned by William's sister, but I'm pretty sure that would be the case. So things are very unlikely that it would have changed over time. So that structure seems sort of fixed in stone. The performance of the whole thing is not all that really, and I know if we compare it now to what we look at personal assets, it's similar-ish, but it's not invested in the same sorts of things. So if you look at the NAV performance here at the top and compare it to things like equities, it's yeah, not all that great. And there it is within the context of the flexible investment sector. So it's the same chart that I gave you before with when I did ranking personal assets on 5-year numbers. So it's down a bit lower. All this was triggered by some media speculation in Brazil. So obviously they have been talking to people about the idea of selling off Wilson & Sons in some way. But it is just speculation. Nothing seems to be concrete. It says it's very early stage. There hasn't been a bid for it. I'm guessing they might have said something in the results that are about to come out. They will have to say something more now. I don't think anything massive is going to come out of this. Even if they sold the whole thing for cash, I mean, they can always about cash in. I cannot really see them doing anything particularly shareholder friendly with it. It's possible that they pay out a massive special dividend. It seems very unlikely to me. It's possible that they might try and buy in more of the minorities, but whether they do that at a price that was actually attractive or not, because they probably wouldn't have to, I don't know. You are a bit at their mercy because they control it, and as a non-voting shareholder probably, or maybe with all the share shareholder, you've got no influence over things. So regardless of the huge discount, regardless of this excitement, I probably would leave it alone. Lastly with this, Custodian Property Income REIT. It's announced results this week as well, which you can read on our website. Obviously, the asset value is falling because of what's going on with interest rates rising, and that means property yields rising too, and so value is coming down. It's focused on UK commercial properties, smaller stuff. One of the things that it said that I thought was interesting is they think the valuations are stabilized a bit now. And obviously, as rates keep marching up, that might no longer be the case. We may see another leg down. We'll have to wait and see. But the interesting thing, and the reason that I'm talking about it, is that they believe that there is scope for them to do more merger, so bid activity to expand their fund. The sort of noises they're making is they kind of like to double it, which I think is quite ambitious. They did a small acquisition of Drum Income Plus REIT last year, I think, or maybe the year before. They'd like to do more things like that. So I just pulled out a list. This is all the things that are smaller than it. I know they're tickers here rather than names, but there's a whole bunch of things in there, including the Ediston Property Investment Company, which has already said it's looking for something to do. So it may be that Custodian is making an approach to that. A whole bunch of other things in there that we quite like, things like the Aberdeen Property Income Fund, for example. I'd be surprised if that went out. Regional REIT, I know we quite like that one. But nevertheless, there is quite a long list of things that are smaller. So it is possible they'll be able to do something, but we'll just have to wait and see. Now then, that's enough from me.